Alright, welcome back to the channel, everyone. I'm Murph, he's Cooper, and today we are tackling something that sounds, on the surface, completely insane. I mean, genuinely, when Cooper pitched this to me, I thought he'd been spending too much time on the weird side of the internet.
It does have that initial shock value, I'll admit.
Shock value? It's a paradox wrapped in a contradiction. The title of this episode is I Tried Warren Buffett's Strategy on Crypto, and for anyone who's been paying attention for the last decade, Warren Buffett and crypto go together like oil and water, a steak and ketchup, in a screen door on a spacer. The man called Bitcoin rap Poison Squared.
He did. And he's not wrong from his perspective. His framework for value is built on productive assets that generate cash flow in a way you can model out for decades. And for a long time, crypto didn't offer a clear answer to that. But that's the whole point of this experiment. It's not about whether Buffett would ever buy crypto, we know the answer is no. It's about whether his timeless, battle-tested principles of investing can be successfully adapted and applied to this new, chaotic, and often irrational asset class.
So you're not trying to turn the Oracle of Umhot into a crypto bro. You're trying to see if the ancient wisdom can tame the modern beast.
Precisely. And before we dive in, let's get the big, flashing neon sign out of the way. This is absolutely not financial advice. We are not financial advisors. This is a thought experiment with real-world application that we are sharing for educational and entertainment purposes only. Do not go out and buy anything based on what we say here. Your capital is at risk, especially in an asset class as volatile as crypto. Please do your own research.
Seriously, folks. Don't mortgage your house on a JPEG of a monkey or coin named after a dog. Okay, disclaimer done. Cooper set the scene for me. When did you start this, and what was the catalyst?
The idea had been brewing for a while, but the real catalyst was the bottom of the bear market. Think late 2022, early 2023. The FTX collapse had just happened. The market was a sea of red. Sentiment was at an all-time low. People were calling crypto dead for the 20th time. And all I could hear in my head was Buffett's most famous quote, "Be fearful when others are greedy, and greedy when others are fearful."
Okay, so the entry point was classic Buffett. Buying when there's blood in the streets.
Exactly. The noise was deafening, but the fundamental signal, if you looked for it, was still there. And I thought, what if I ignored all the noise, all the Twitter traders, all the hype, and just approached this like Buffett would approach buying a steak in Coca-Cola or See's Candies? How would that even work?
So that's the first question. Let's break down the pillars of his strategy. First one is always circle of competence. Invest in what you understand. In crypto, where there are 20,000 different projects, most serve them incomprehensible spaghetti code with a vague white paper. How did you even start to define a circle of competence?
That's the first and most important filter. My circle of competence in crypto is not all of crypto. It's not even all of DeFi. I had to be brutally honest with myself. I eliminated 99% of the market immediately.
What got cut?
Meme coins. Done. It doesn't matter if they do a 100x. I cannot analyze the fundamental value of Dogecoin or Shiba Inu because there is none, by design. It's a cultural phenomenon, a bet on attention, not a business. Buffett wouldn't touch that. Also gone were the overly complex, experimental DeFi protocols. If I couldn't explain to you, Murph, in a simple paragraph what the protocol does, how it generates value, and what its specific purpose is, it was out. I don't have the technical expertise to audit smart contracts myself, so I have to rely on projects that are simpler, more established, and have a clear, understandable business case.
So you basically narrowed it down from 20,000 projects to what? A few dozen?
At most. I focused on Layer 1 and Layer 2 blockchains, and what I call critical infrastructure protocols. Think of them as the digital nations and the toll roads of the crypto economy. Their business model is relatively simple to grasp. They provide service-secure block space, computation, data verification, and users pay for that service. It's a model I can understand.
Okay, that makes sense. You're not trying to understand the flavor of the week, you're trying to understand the foundational tech. So, after you've got your small circle of competence, Buffett's next big thing is the economic moat. A durable competitive advantage. What on earth is an economic moat in an open source world where anyone can copy your code?
This was the most fascinating part of the exercise. A moat in crypto looks different, but the principles are the same. I identified a few key types. The first and biggest is the network effect.
The Metcalfe thing. The value of the network grows exponentially with the number of users.
Precisely. Ethereum is the king here. It has the most developers, the most decentralized applications, apps, the most users, and the most assets logged on its platform. A new layer 1 could launch tomorrow with faster technology, but it faces an immense uphill battle to convince thousands of developers to abandon the ecosystem they know and trust, and to migrate billions of dollars in liquidity. That's a massive moat. Bitcoin has an even stronger one, but of a different kind.
Which is?
Its moat is its brand, its security, and its pristine decentralization. It has the most powerful and secure computing network in the world protecting its ledger. It has a decade-plus track record of no downtime and perfect operation. Its brand recognition as digital gold is unparalleled. No other crypto can claim to be the original, the most secure, and the most credibly neutral. That's a moat that's almost impossible to replicate. It's like trying to create a new Coca-Cola. You can make a new cola, but you can't make it *the Coca-Cola.
So, network effects, brand and security. What else?
I also looked at what I call a technology and integration moat. This is where a project like Chainlink comes in. They provide Oracle services, which are basically the pipes that connect blockchains to real-world data like asset prices or weather information. They are so deeply integrated into almost every major DeFi project across multiple chains that to replace them would be like trying to rip out and replace all the plumbing in a skyscraper. It's possible, but incredibly difficult and expensive. Their first mover advantage and deep integration create a very sticky service.
So it's less about a secret formula and more about being so deeply embedded that it's a pain to switch. Like trying to switch from an iPhone to an Android when all your family is on iMessage.
That's a perfect analogy. The high switching costs, driven by network effects and deep integration, are the crypto equivalent of a Buffett-style mo.
Okay, this is making more sense than I thought it would. But now we get to the hardest part. The absolute crux of the issue and why Buffett dismisses crypto. Intrinsic value. He calculates what a business is worth based on the future cash it will generate. You can't do a discounted cash flow analysis on Bitcoin. So how did you assign a value to these things beyond just the market price?
This is where you have to be flexible and admit you're not dealing with absolutes. You're working with frameworks and models, not certainties. I couldn't use a DCF, you're right. But you can asterisk value a network. I used a few different models. For the big layer ones like Ethereum, you can look at it like a business that generates revenue.
How does Ethereum generate revenue?
Transaction fees. Every time someone uses the network, they pay a gas fee. A portion of that fee is now burned, permanently removing it from supply, and another portion goes to the stakers who secure the network. So you have a network that is generating billions of dollars in annual fees. You can then create a price-to-sales ratio, or in this case, a price-to-fees ratio. You can analyze the growth of those fees over time. Is the network's revenue growing? Is usage growing? This starts to look a lot like analyzing a high-growth tech stock. It's not a perfect science, but it grounds the valuation and actual economic activity happening on the chain.
So you're valuing it based on the economic traffic it supports. What about for Bitcoin? It doesn't have smart contracts generating fees in the same way.
For Bitcoin, the valuation model is different. I treated it as a non-sovereign digital store of value. The best analog isn't a company, it's gold. So the valuation framework becomes a total addressable market, or TAM, analysis. The total value of gold is around $14 trillion today. The total value of the offshore banking system and other stores of value is in the tens of trillions. Bitcoin's market cap today is around $4 trillion. If you believe it can capture even 10% of the gold market, that gives you a valuation target right there. If you think it can capture 5% of the global store of value market, that gives you another one. It's a macro asset, so you value it based on its potential role in the global financial system.
So for Ethereum, you're a business analyst. For Bitcoin, you're a macroeconomist.
A very amateur one, but yes. The point is to have a rational thesis for its value beyond number go up. And this thesis must be based on its moat. Ethereum's value is tied to its network effect moat. Bitcoin's value is tied to its digital gold moat. The story and the valuation have to align.
Well, okay. That leads directly into the next Buffett pillar, margin of safety. Buying something for significantly less than your calculation of its intrinsic value.
And this is where buying in late 2022 was key. Let's take Ethereum. Its fee revenue was still significant even during the bear market, but its price had fallen over 70% from the peak. My price to fees models were showing it was trading at a massive discount compared to its historical average and compared to a similar growth tech company. For Bitcoin, the digital gold narrative was being laughed at, but the macro environment with high inflation and geopolitical instability was actually making the case for it stronger than ever. The price was around $16,000, but my conservative models based on it capturing just a fraction of gold's market cap suggested a long-term value that was multiples higher. The margin of safety was huge.
So you weren't trying to time the exact bottom. You were buying when your valuation model showed a clear dislocation between price and value.
That's it. Buffett says it's better to be approximately right than precisely wrong. I had no idea if $16 was the bottom for Bitcoin. It could have gone to $10, but I was confident that it was significantly below its long-term intrinsic value, providing a substantial margin of safety.
And the final pillar, which is kind of the simplest but maybe the hardest in practice for crypto, long-term horizon. For Buffett's favourite holding period is forever. In crypto, long-term is often considered to be next Tuesday.
Thus, it's true. The temptation to trade is immense. You see a 30% pump and your brain screams to take profit. You see a 20% dump and your panic instinct wants you to sell. Applying the Buffett mindset meant I had to completely shut that off. I bought these assets based on a multi-year, even decade-long thesis. I wasn't buying them to sell in 3 months. I put them in cold storage and decided I wouldn't look at the price every day. My plan was to hold, and perhaps add more if the price fell even further below my intrinsic value calculation, but not to sell based on short-term market movements.
So you truly bought and held. No trading, no chasing pumps.
None. It was an exercise in extreme discipline, especially in this market.
Okay, this area is sound. I'm actually impressed with how you've translated these boomer financial principles into the digital age. But let's get to the clickbait title. Let's talk about the insane results. You built this hypothetical Buffett-style crypto portfolio in the depths of the bear market. What did you actually put in it? And how has it performed?
The portfolio was simple, reflecting the circle of competence. It was heavily concentrated, another Buffett trait. He says diversification is protection against ignorance. If you know what you're doing, you make a few big bets. So, my portfolio was about 80% concentrated in the two pillars.
Bitcoin and Ethereum.
Correct. Roughly 45% Bitcoin, 35% Ethereum. I see them as the Berkshire Hathaway and B shares of the crypto world. They are the bedrock. Bitcoin as the ultimate pristine collateral and store of value, and Ethereum as the decentralized world computer and yield-bearing economic engine.
And the other 20%?
That 20% was for what I called high-conviction infrastructure plays that I felt had extremely strong moats. I allocated about 10% to Chainlink for the plumbing of the 5 reasons we discussed. Its necessity across the ecosystem gives it a powerful, sticky moat. The final 10% I put into Solana.
Okay, Solana is interesting. That was a controversial choice back then. It was heavily associated with FTX and some bandwidth ride, and its price got absolutely hammered. It went from over $250 down to less than $10.
And that's exactly why the margin of safety was astronomical. The market was pricing it for death. But when I looked past the SBF association, I saw a layer 1 blockchain with a legitimate technological moat. Its speed and low transaction costs were, and still are, orders of magnitude better than Ethereum's. The developer community, while shaken, hadn't abandoned it. I made a bet that the technology was strong enough to survive the bad PR. I saw a credible competitor to Ethereum trading at a 95% discount. The risk was high, but the potential reward, if it survived, was immense. It was a classic Buffett-style cigar butt investment at that point, one good puff left in it, but with the potential to be much more.
A high-risk, deep-value play was in the already high-risk crypto space. Artsy. So, the portfolio is set: Bitcoin, Ethereum, Chainlink, Solana. You bought in late 2022 and early 2023. You held. We're now in mid-minus 2024. The market has recovered significantly. The Bitcoin ETFs were approved. The sentiment has completely flipped. Tell me the results.
The results were, well, they were insane, just like the title says. And the insanity isn't just in the final number, but in how stress-free the journey was compared to how most people experience crypto. But let's talk numbers first. My entry point for Bitcoin was an average of around $18,000. Today, it's hovering around $70,000. That's nearly a fork's return on the largest portion of the portfolio.
A 300% gain on the core holding. Solid.
My entry on Ethereum was an average of about $1,300. It's now trading around $3,800. So that's almost a 3x. Chainlink I got in around $6. It's now around $18, a clean 3x. And then there's the Solana cigar bet.
I'm ready for this one. You bought it under $10.
My average entry price was about $12 to be precise. Today it's trading around $170.
Wow. Okay. That's the 4x. That is a truly insane result on that part of the portfolio.
It is. So when you blend it all together, the entire portfolio from the bottom of the bear market to today is up significantly. We're talking about a blended return well into the high triple-digit percentages. It dramatically outperformed just holding Bitcoin alone, thanks to the outsized returns from the higher risk, deep value plays like Solana.
That's incredible. But here's the obvious question, the one every skeptic is screaming right now. Was it the strategy, Cooper? Or did you just get lucky? You bought at the bottom of a bear market and rode the wave of the next bull cycle. Couldn't you have bought almost any top 20 crypto and seen similar, if not better, returns?
That is the single most important question to ask. And the answer is complex. Of course, market timing played a huge role. Getting in during a period of maximum fear was essential. That is part of the strategy. But the strategy did more than just tell me asterisk when asterisk to buy. It told me asterisk what asterisk to buy and, just as importantly, asterisk what not to buy asterisk.
Go on.
During that same period, there were dozens of other hype projects. Other layer ones that have since faded into obscurity. Projects that didn't have a real moat, that were just marketing hype. They might have had a quick pump, but they didn't have the staying power. The Buffett framework forced me to avoid those. It filtered out the noise and the speculation. I didn't buy Terra Luna before it collapsed because its value proposition was based on a flawed algorithmic model I couldn't competently assess. It was outside my circle. I didn't buy the meme coin of the week. The strategy acted as a powerful quality filter.
So you're saying this strategy prevented you from making the catastrophic errors that wipe most people out?
Precisely. The biggest insane result wasn't the fortings on Solana. It was the 0% loss on portfolio killers. In crypto, defense wins championships. The Buffett method is first and foremost about capital preservation. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. By focusing on moats and the semblance of intrinsic value, I built a portfolio that was resilient. It was composed of projects that were most likely to survive and thrive in the long run.
And what about the psychological aspect? You said it was a less stressful journey.
Immensely. Because I had a clear thesis for each investment, I wasn't rattled by price swings. When the market dipped 15% in a day, I wasn't panicking. I was reevaluating, has my thesis changed? Has Ethereum's network effect eroded? Has Bitcoin's security been compromised? The answer was always no. So I could hold with conviction. I wasn't just holding onto a ticker symbol, I was holding onto a well-reasoned investment case. It removes the emotion from the equation, which is the single biggest enemy of the average investor.
So the insane result is twofold. One is the financial return, which is obviously fantastic. But the second, and perhaps more profound result, is the intellectual and emotional framework. It brought center of common order to the absolute chaos of the crypto market.
That's the core takeaway. The experiment proved, at least to me, that you don't have to be a degen trader staring at charts for 18 hours a day to succeed in crypto. You can apply these boring, century-old principles of value investing and not only get great results, but also sleep at night. It's about shifting your mindset from gambling on price action to investing in technology and networks.
So, what's the biggest flaw in this whole thing? What's the counter-argument you still wrestle with?
The biggest flaw remains the calculation of intrinsic value. It's still more art than science. The models I used for fees of total addressable market are just that, models. They're full of assumptions. A traditional business has audited financial statements, physical assets, and predictable cash flows. Crypto assets are still nascent, and their value is part network fundamentals, part macro narrative, and yes, part speculation. You have to be comfortable with a much higher degree of uncertainty in your valuation than Buffett ever would be.
So the margin of safety needs to be even wider to account for the uncertainty.
Exactly. You need an almost absurdly large discount to what you think it's worth to justify the investment because your valuation could be off by a wide margin. The other risk is regulatory. Buffett invests in predictable regulatory environments. Crypto is the Wild West. A single law from the SEC could dramatically change the landscape overnight. That's a risk that's very difficult to model.
It seems like the core lesson here isn't to perfectly replicate Buffett, because he can't. It's to steal his principles and adapt them to a new territory. To use his compass to navigate a new map.
That's the perfect way to put it. It's not about following his rules dogmatically. It's about internalizing his mindset, be a business analyst, not a market speculator. Think long term. Demand a margin of safety. Stay within your circle of competence. Control your emotions.
So, as we wrap this up, what would you say to someone listening who is intrigued by this? What's the final takeaway?
The final takeaway is that process is more important than prediction. My success wasn't because I predicted the market would turn around. It's because I had a disciplined process for identifying quality and value during a time of panic. The strategy forces you to do the work. It forces you to ask the hard questions. Why does this project exist? What is its competitive advantage? How does it create value? Who are its customers? If you can't answer those questions, you have no business investing in it.
It's the ultimate antidote to FOMO, fear of missing out.
It is. It's a framework for JOMO, the joy of missing out. The joy of missing out on the hyped up garbage that will eventually go to zero. The joy of missing out on the stress and anxiety of day trading. You focus on the one or two things you truly understand and believe in for the long haul. The result of that focus, as we've seen, can be pretty insane.
Incredible stuff, Cooper. You've taken the most crypto-skeptical philosophy on Earth and turned it into a coherent and wildly successful strategy. It's a testament to the idea that true investment principles are timeless, even if the assets change.
Thanks, Murph. And to everyone listening, remember, this was our experiment. The market is always changing. Don't take our word for it. Think for yourself, do the research, and be skeptical. Maybe even as skeptical as Warren Buffett. It might just be the most profitable mindset you can have.
A perfect place to end it. Thanks for tuning in, everyone. We'll catch you on the next one.